Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
All right, welcome. Thanks for being with us. I'm Chris Boyd. I'm here with Jeff Ferry and Russ Ball. We are all of the AMR team. Glad to have you with us for another episode of Something More. And today we're talking about markets and market risk. And, as we continually bump up to new highs, people get very excited about stocks. And it's good to have the exposure to the growth in wealth that comes with equities, but there often is volatility, and can be a risk. And so oftentimes people are worried about when's the other shoe going to drop, what's going to cause markets to have a problem. And so, I think it's important for us to keep perspective. So we'll talk about some of these risks, but let's remember, one, most people don't have only stock. They have other investments too. Hopefully you have some reserves, so it's not everything of your investments in your portfolio per se, to have some liquidity to have. And, recognize that volatility is part of the process. We get benefit from participation over time. And what drives markets ultimately is a combination of things when it comes back to profitability. Are companies, broadly speaking, going to be more profitable or less profitable as we look into the future? And if we expect they're going to have increased profitability, we might expect to see performance of stocks grow, the market to grow. If we think that things are going to be disrupted for a longer time, that may change the way we think about the performance of stocks. I'm sure there's more that we can dig into, but let's start off. Jeff, tell us a little bit about what we want to hit on, the risks that might be out there today that people might be focused on.
Well, unfortunately, I think people are too focused on the risks by watching too much television, because if you can watch the financial channels or the cable news channels, and it seems to be this unending risk news, right? So we have the risk of the government shutdown. I guess we just
alerts, right?
breaking
news, right? The music chimes, like, what's happening?
Do you remember the day when breaking news was actually something everybody ran to actually happen? You ran to the living room to say, what's going on in the world? A major world event is happening.
Totally. And now it's just kind of, hey, this is what we're talking about today. It's breaking news. It's not always breaking news.
No, it isn't. But something that it's not breaking, it's actually 37 days old. One of the risks that people are starting to calculate or attempt to measure, is it a risk to the stock market and investments, is the government shutdown. We're in day 37 here and counting. There doesn't seem to be, light at the end of the tunnel, at least not at the moment. And, at first glance for the short shutdown, I think if you're a government employee, this is a whole different conversation, right? If you're a government employee,
you got to have that caveat. You're right. Right? If you're someone whose job is disrupted, your cash, your paychecks are not coming in, it's a very different story than kind of everybody else who's not a government employee.
Yeah, I don't want to come across as not being sympathetic to our federal employees and contractors and all the people that are related to this. But just from a broader perspective about risks to your portfolio, risk to the market, risk to the economy, I think when it started, the government shutdown, people assumed, a week or two, de minimis, not a big deal. We know that a lot of money that people get paid on isn't in the economy, but one paycheck that'll catch up, they get retroactive. But now, I don't know Chris and Russ, if you see this differently, this is starting to mean something to the broader economy and could even mean more the longer it goes on.
Russ, you want to comment?
Yeah, I mean, it's definitely longer than we probably thought when this all started, and longer than a lot of people thought. Usually these government shutdowns are, a couple weeks, and then
Okay.
it's wrapped up. There's some kind of agreement, and at least things are kicked down the road a little bit. Not so much this time. I know President Trump was making some comments the other day after the some of the wins for the Democratic Party in the elections. Was that yesterday or the day before? Can't remember.
A couple days ago. Yeah.
But he was referencing the fact that he thought the government shutdown did have a negative impact on the Republican turnout, and that was sort of like, all right, I wonder what's going to happen out of this. Is this going to be more digging your heels in, or looking to go to the negotiating table? So remains to be seen, but the longer this goes, the more the market's going to get jittery, I would imagine, and start wondering, something's got to give here.
Well, the uncertainty of it all, it's uncertain because we don't know the end, but it's also uncertain on things that we rely on to gauge how the economy's doing. The federal government is the primary source of data, unemployment data, CPI data, so forth, all these things that the Bureau of Labor Statistics and individual regulatory agencies of the federal government report out as a normal course of business, kind of guide people who are looking at the market and gauging whether or not the economy's strong. Are we in a recession? Is the Federal Reserve more likely to lower interest rates because of unemployment issues, et cetera? And so it's been a month and we don't have any of that data. So that leads to uncertainty, and the market doesn't prefer uncertainty.
And I know Fed Chair Powell is talking about, right now it's like we're driving a car down a foggy street, and there's not a lot of information, and he's definitely urging caution in terms of what the next Fed move is going to be. But that's a good analogy as to where things stand right now. It's hard to know when you don't have the barometers that you're used to.
And there are some real
point too. What happens when you have that foggy environment? Things start to slow, right? You get more cautious. And that happens in business as well.
Either that or you drive off the road. Right? And it has some not just uncertainty, but it has some real life practical negative impacts on the economy. You think about companies or organizations that have to go for regulatory approval to do something, whether it's to permit something or to, whatever it is. So much of these processes go through the federal government at some point, and that's just not functioning either. And so there's a backup building there. It's going to lead to a slowdown in those projects, which, leads to a slowdown in hiring, et cetera. So I think the initial thought, Russ, I agree with you. A couple weeks now we're into day 37 and counting. And the longer it goes, the greater the financial economic impact it has to people, and the uncertainty for the employees, of course.
And there's greater demands for help and assistance for people like, and that throws off paying and spending, and there's a slowing effect in that regard as well.
Yeah, one of our clients is one of the managers of a food bank down here, and through the Catholic Church, the church has their own food bank, but it's a very robust one, serving more than the church, more than the parishioners. And I saw him the other day, and he's just like, they are out straight with having to limit what people take because, they can't feed the whole community. And the church is putting in extra money, and it's impacting that part of the economy as well. So, they just, yep. And it's a larger political question, but the 40 million people on SNAP benefits did not receive their benefit. And that money filters its way into the economy. I mean, they spend it on perishables and, food items primarily, and those purchases are not being made. And so, does that affect certain industries? Of course it does.
Right.
So that's one of the kind of right now risks to the market.
That's a tangible, I think, that example when you Rich give in terms of how this has some ripple effect, where I think a lot of these are things that we kind of don't see so much,
Right.
but it's still there having an effect. We're just not as it's not as in front of us in the news as much. Yeah.
Another market risk that I've been thinking about a lot is not directly related to the government shutdown, but tangentially it's certainly related, and longer it goes is we're starting to see some cracks in the credit and debt issues of consumers before the shutdown, where more and more student loans are being in default. There's some cracks in the car loan numbers. People are getting behind on those. I think before the government shutdown, it was probably related to, pressures on inflation, such job fears, but this is all just going to magnify those credit and debt issues, I think.
I agree. I mean, there's going to be a lot of people who are trying to fund their circumstances in the government shutdown with no paycheck or disrupted income with credit.
Right.
This will have a prolonged consequence.
Or not paying credit that you already have.
Or not paying credit you already have. Yeah. They're going into default.
No, your student loan is pretty far down the list when you're trying to put on the table and keep the lights on.
Right. And stay in your home,
Yep. So all these negative things and kind of local things and things that might be part of the government shutdown are risks to the market. The market is, I don't know, maybe this week paying a little bit more attention to it. Seems to be some increased volatility.
Yeah.
Not the straight line. Well, we still have those things that always are risks to the market, and certainly in our news. Global tensions, global issues certainly drive the market volatility, positively or negatively. So I don't know. You think we're having improvements in the global risk to the market? We had President Trump kind of make a deal with China, or at least a positive meeting. He seemed to have a good meeting with South Korea and Japan.
Yeah, certainly other parts of other countries as well. Whether or not we had material improvement with China remains to be determined. But at least tonally, I guess you'd say there's improvement. But yeah, with other countries, you did get some furtherance of trade negotiations. Like always forget the rare earth metals deals.
It seems to be a positive, yeah.
Sure. So, fingers crossed. I think broadly though, when you talk about global issues, there's always the uncertainty of tensions with countries and what will bubble up. I mean, we see some improvements, I'd say, in the Middle East, right?
Right.
What's happened recently with Gaza and so forth. That seems to be moving in a more favorable direction with Israel and Palestine. With regard to Ukraine, though, that remains really not in any kind of a better trajectory as we look at and then there's always the unknown.
Well, one of those might be the military presence off the coast of Venezuela that's increasing the last week or two. I think the world's largest aircraft carrier is on its way down there.
Yeah, the Gerald Ford. Yep.
Right. So who knows what's going to happen there? But when you see troops amassing, it's never a good sign for the geopolitical sphere.
I mean, that's a whole show in itself with the military action against civilian. Jeff, we've talked about this before. Civilian
narco terrorists.
Yeah,
the term that we've applied to this.
Perhaps we think, right? If unproven, right? is, but presumably.
You have to label it something if you're going to kill it.
You know what I mean? So like, but the whole like, is this lawful? You know, that aspect, and then this idea that we're going to amass military might in a region with a country we're not at war with. Are we proactively going to invade or strike a country that we don't have any kind of military, any declaration of war?
Yeah, actions do speak louder than words. The words indicated by the administration is no. That's no, we're not. But we're certainly flexing our military muscle in the region, and that can be appropriate as a tactic sometimes.
Or yeah, some kind of tactic.
It can be. However,
And also be a target, and also.
Well, that's where I'm going. At certain times in our history, us flexing our muscles has resulted in a response that it should be expected. I mean, if you're flexing your muscles, somebody might punch you in the nose, and then the response leads to a response and
escalation.
That's right.
Yeah.
History is full of those things. So to your point, Russ, and then there's Venezuela, right? I mean, so who knows what the next thing is, and
Right.
so yeah, other areas of unknowns and uncertainty that I think that can drastically affect the news cycle and most likely the market is the Supreme Court case that was heard this week, challenging the president's unilateral tariff moves, if you will. In other words, does the president have the authority to start a tariff, institute a tariff on a foreign nation without congressional approval? If you're a student of history, it's been done before. If you're a student of the Constitution, you don't see that power in the Constitution. It is actually delegated to Congress. And, the question is, and the justices, if you listen to their questions, which were broad-based meaning from the liberals and the conservatives on the court, is a tariff a tax? If a tariff is a tax, then the president cannot do it, I think is what they're what they're struggling with, because Congress is the entity that creates taxes and regulates taxes, not the president. And so the big what if, I think the prognosticators are starting to go down this road, is if the Supreme Court overturns these tariffs based upon a lack of president authority and the bills that the legislation that he's using as an excuse to do it has never been done for this as well. If those taxes are revoked, those tariffs, I guess I showed my opinion, are revoked, what happens? Do we have to pay back the money? And what does that mean to our debt and budget and all the things that are related to it? So I think that news.
And I think the White House has been saying that if this is struck down, we'll just deem it a different under a different power provided to the executive branch by the Congress.
Well,
so they'll just label it a different kind of tariff.
And then we're back to square one. It goes,
we start over.
It goes.
Yeah. You can label a chicken a duck.
I don't disagree with you, Jeff. Don't get me wrong. But I think that's the positioning that I've heard come out of the White House, is that, well, if that's not approved, we'll do it in a different format.
Well, I said on a previous episode, this is months ago, and probably when it first came out, this issue anyway, is why doesn't the Republican Congress just pass a law giving the president authority to tariff up to whatever they decide? Yep. It would have made this case moot if the president then had authority. They could have argued about between Liberation Day and the passage of the law. Yes, but I'm surprised that the Republicans didn't do that. And they could do it now or soon. They probably wouldn't get it past the Senate. Another issue. They could give the president authority, but a conservative court which this court is, should be most interested in the four corners of the Constitution and limiting presidential authority, not expanding it.
Right.
So I think that's where the case is going. And what happens to the tariffs is open. I mean, the court could say, effective today, it wasn't clear that you didn't have the authority, blah, blah, blah. Yeah. Starting today, you do not have the authority, so no further. But that's still it's gonna impact the market. Arguably, if that was the decision, it could affect the market positively.
Yeah.
Right?
Yeah.
So it's not exactly a black swan, but it is an unknown.
I don't know if you listened to any of that, Jeff, yesterday, but I had it kind of on in the background, and a lot of it was over my head because they were really getting in the weeds of the language of the AIFA rules and all that. So, but it did sound like they were leaning against the president, at least from the questions that were being asked. So I don't know. It'll be interesting to see how that plays out.
It did, but if you I've listened to these cases for a long time, being a former attorney, I'm interested in this and constitutional issues. Sometimes you ask a question to maybe give your side an opportunity to directly answer it for the other members of the court. But they did, if you just took them on the face value of the questions, it does not sound positive for the administration.
Right.
Yeah. Talking about market risk, one of the biggest things, that I look at, that I think about is this market too high? Like, it's not a general market risk, like for, forever, but is this moment in time, is this market, are the valuations of this stock market, maybe especially the AI side of it, are we too frothy?
Well, I think that is a recurring question that keeps coming up when we look at. Typically, we talk in terms of price to earnings ratios. They seem extended, and I think this is a challenge to address. Brian has endeavored to address that for our clientele. Right. He's made the case that one, the profitability prospects are very high and continue to grow at a rapid rate, and that can help to justify some of these numbers. I think I don't speak for him. I think that's one of the arguments people make. I think another he makes is this idea of a lot of these companies that have multiples have recurring revenue, and they're more of a subscription-based revenue design, and that can justify a higher multiple. And then the idea that the market as a whole, its composition is very different. The kinds of companies, the kinds of ways in which revenues are derived and profitability is derived is different than it used to be, and that it is more maybe with greater predictability and greater worthy of a higher multiple in some respects. We didn't talk about interest rates, but Brian certainly would. That notion that where interest rates are is a factor in all of this as well. What's the alternative that we're comparing things to is part of that equation as to what I might consider a willingness to pay for a stock. So a variety of inputs there. I think it remains a valid, reality concern. Not to say that it's maybe not as big a concern as we might think just by looking at the PE, but I think inevitably, we're always paying attention to market valuations. Certainly today, I don't think you'd argue the market is cheap. And as an investor, you think about where you start, the point from where you start. If you're putting new money to work, it's different from, hey, I've been enjoying the ride, right? Yep. And you might have more tolerance as someone who's put money in a long time ago and had a good run. And and it's with volatility, you give up some of the gains, but it comes back eventually. That kind of mindset. Whereas if you're putting new money to work and you're buying in, and then there's disruptions, it's a little more of a painful process, and it should be a longer wait to get to the other side. Volatility is inevitable, and I think as an investor, we have to have that mindset that that's why we get better returns. We get greater compensation because we take more tolerance for enduring bumps in the road, the ups and downs. But in consideration for that, we get better return. So, I don't know. I think it concerns me, but I think I listen to experts, as Brian is, in making the case that the prospects for profitability largely outweigh those concerns for valuation being extended. What do you think?
I agree with everything you said, and I generally agree with Brian's comments on this during our recent webinar that we had, which people can check out on YouTube. We have a version for non-clients on our webinar if they'd like to check that out. I'll throw the link in the show notes if people want to review that.
And with that in mind, maybe for next week, what we'll do is we'll have Brian come on and talk a little bit about this issue and others to really kind of elaborate on the notion of where are we in the market and how do we deal with it as a firm and our strategies and our team and our clients' portfolios that we manage with discretion. We pay attention to a lot of these risks, and it doesn't mean that we're not positioning with these in mind. But it's a very difficult scenario right now. On the one hand, you've got good things happening. On the other hand, we talked about some of the challenges with that are stressing the markets. So, how do you position? And Brian's taken a lot of effort in trying to position us both for enjoying some of the benefit while mitigating risk. And how do you do that when there's this sort of bifurcated possibility?
Yeah, and we're making really broad comments about general views. This is a super individual analysis that we do for our clients. This is a different conversation depending on your time horizon. If you're in retirement and you're using some of these invested funds in the near future, this could be an opportunity to take some risk off, and build your liquidity bucket so you have the cash in the event of a market downturn.
Rebalance to your intended allocation. Maybe that's changed over time, and it's a good time to, when markets are relatively high, it's a good time to think about, do I want to take some money for next year's spending?
Exactly.
Do I want to refill my buckets? Do I want to reallocate? These kind of things.
Yep. And if you're on the other end of the spectrum, if you're Russ over here in your accumulation phase, and you are investing in your 401k or maybe adding some money to a brokerage account, the old adage, John Bogle's, is it's time in the market and not timing the market. You just want to keep dollar cost averaging. You just want to keep contributing. You don't want to jump in and out because you're not going to do it at the right time. Nobody does that successfully long term.
If there's market disruptions, who cares at that stage? Because you're buying.
I remember rooting for them.
And you're getting good deals when that happens. So today's stocks at yesterday's prices, that kind of thing.
Yeah.
So for the younger investor, just ignore it.
Buy. That's right.
Kramer would say,
right? Yep. Buy. So, this is a good example of where, a financial advisor, a trusted financial advisor that you work with, if you have these concerns, you talk to him or her about it, because the issues that you noted, Chris, about liquidity and maybe you want to reduce your risk, you can talk that out without making an emotional decision. most of the decisions that people make when the market's up or down, to the extremes are the wrong decisions. It's just the data on this is so clear that when the market's up, so many people say, get me some of that. And when the market's down, they say, get me out. And that, might feel like an emotional, like survival technique, but it's, greed and fear shouldn't drive your decisions.
Yeah.
And that's where an advisor can really, earn their keep by helping you walk through those and going through and having a financial plan that's written that you review and that helps you make these larger decisions and without making a greed or fear decision.
Well said. I think when you look at where we're at with markets, again, S&P 500, some are up around 15% year to date. And then, when you look at longer term numbers, they're extended in the sense of we're at rates of return that are higher than we would expect long term.
Right.
If you say, looking back, 3 or 5 years or something, your performance from the market is looking more appealing than it probably will forever. You know what I mean? The long-term returns from markets tend to be a little lower than what we're currently at for these rates of return, annualized rates of return. So that doesn't mean that there's necessarily a return to the mean or whatever, the reversion to the mean, but
Right.
I do think it is probably realistic to think if his long-term averages are somewhere around 10 or 11% from stocks, we're averaging somewhere around 15 or whatever it might be. You might expect that there's going to be offsets to that at some point. That's just the reality.
That's rational. Yep.
Yeah.
I think people are so used to over the last 3 years, I mean, us included, I guess, in seeing the market go up, and there are these little blips where there's like the Liberation Day or, even COVID could be big picture seen as a bit of a blip in terms of
Came back so quickly.
right, the way the market bounced back, and it's pretty much been a straight line up. When you look at the chart, other than these minor 1 or 2 month periods, um, since I guess after 2022. So we're used to these double digit returns, and I remember at the beginning of the year we were looking at valuations, and we were like, this looks pretty expensive. But
Good point.
on that, if you weren't invested, you would have missed out on these again double digit returns, which thought were unlikely for 3 years in a row. But here we are. There's still some time left in the year, but it just goes to show that trying to time these things and trying to make these decisions, thinking you have some foresight, it's not a winning game.
No.
You can't help but make parallels to the late 90s, though, at times, because of when you have these back-to-back big return years, you start to recollect some of that experience.
Yep. And we do have
It was the late 90s that the last time there were 3 consecutive years of double digit returns. So that was the leap to the early 2000s.com.
Yeah, but and even that, I mean, people in that period of time, there were long periods of really good returns, and yes, you had 1998 Asian contagion or whatever it was called at the time. There were disruptions within it, but there was a long period of time with extended favorable returns, and we could be in a period like that where we have prolonged extended, with this AI impact, the benefit, a potential enhancement in productivity and profitability, that it could be consequential, but you just have to be careful it doesn't get away from you as an investor, that you're not so enamored of the returns that you are not attuned to the risks and not positioning in a way that your portfolio is ignoring the risks. you think in terms of that period when there were even the value funds that had gone heavily toward growth, there's just
Well, they had FOMO.
a lack of discipline in the way
Right.
things were structured. And so I think it's a reminder to learn from those lessons. One, you know, be vigilant that you do have to be mindful of having some liquidity, not overstating your risk tolerance in an effort to capture favorable returns, and being disciplined in the way you position your portfolio without going too far one direction or another to be seizing opportunity while at the same time you could be overstating risk.
Yep.
Yeah, it's a challenging thing to do.
Yep.
So, well, that'll be a good thing for us to talk about again more in a future week. Jeff, were there other aspects that you're thinking of with the market risk, or do we cover a lot of today's market risks that people are mindful of?
Well, I think we could do another hour on different market risks, inflation, interest rates, and so forth, the job market, and politics is a whole separate one.
Yeah.
But I think we covered the ones that are on our minds right now, from the government shutdown to the impacts of that, downstream a bit, and world events and so forth. Like, I think we've covered enough risks for today.
So I guess my takeaway for our listeners is there's always risks to be monitored. They can be on this macro level, what's happening in the world, what's happening in the economy, what's happening in the markets broadly. It can be on an investment specific level, what's happening with a particular company I own. Sometimes risks relate to things outside of your portfolio that relate to your own life and your potential needs. All of these variables are things that you may benefit from help in considering. How do I prepare? How do I structure my portfolio? It should always be done in the context of the financial plan. And that financial plan helps you to prepare for the unforeseen with stress tests and the like. And if you don't have that happening with your current advisor or doing it on your own, and you might benefit from a little bit of help, either simplifying your portfolio, paying attention to tax strategies, all of the variables that we tend to, this group here, we take for granted because it's things we talk about with people all the time. But if you're finding some of these concerns resonate, it might be a good time to have a conversation and see if a second set of eyes could be a resource for you, help you navigate how to deal with these. So with that, we leave that door open and offered to our listeners. Certainly reach out to us if we can be a help to you. Until next time, keep straddling for something.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.